good afternoon, or it's actually still good morning, I think, at this stage, isn't it, mate? But g'day, everyone. It's Steve Haas from the ASX Traders United group, and I've got a special guest with us today in terms of our Meet the Traders series that we're actually trying to get started here with this particular group. And I'd love to actually get you introduced you to Nicholas Cook, or he likes to call himself Nick. Got his name there, Nicholas Cook, though. I don't know why. Yeah, we're just trying this out to get everyone a bit more, I suppose, personalised and see what everyone's involved with. And I hope you enjoy this series overall. But g'day, Nick. How's it all going?
Going well, mate. Going well. Cruisy morning. What about you?
Yeah, pretty good. I just thought I'd grab my coffee, and I think you've actually brought your water bottle with you this morning. Is that right?
I did. Yeah. Saving money on coffee so I can invest it.
Well, I understand you're a personal trainer. Is that correct in itself?
Yeah, personal trainer. So I do online stuff and face-to-face stuff as well, which is good fun.
Well, go on. Give it a plug. What do you do in terms of how can people get in contact with you if you're in the Newcastle area? Go on. Do a shameless plug while we're at it. Get it out of the way.
My website is coachnickcook.com, NICCOOK. I basically do online coaching. I'm big on the strength training side of things, so building strength through full range of movement, because I believe in terms of your long-term fitness and health, if you're strong and you build that foundation, everything else is going to be a hell of a lot easier for you. And then the fat loss comes alongside that. So there's my plug. There's my plug.
Awesome. We'll put those details down in the comments as well below and everything too. So if anyone does want to get in contact with Nick too, and you're in the Newcastle area, like I wouldn't be able to, I'm in Melbourne myself. Yeah, definitely get in contact with Nick about that. Now, before we go any further as well, obviously, as everyone does know, anything that is discussed in these forums is obviously not going to be in terms of financial advice. It's more in terms of personal information, just in terms of anything that you do want to act on. Obviously, do get professional advice behind you in relation to any of that. It's, yep, take on board anything you do in terms of information purposes, but definitely do make sure it does actually approach you from your own personal perspective before you do take any action for yourself. But yeah, I've really been looking forward to this, mate, because I understand you do like dealing with exchange-traded funds, ETFs for short. And there's been so much information being drained into everyone's faces about this recently. Lots of advertising saying what are ETFs and all that kind of stuff in terms of long-term investing. And I'm more of a short-term investor. So go on, convince me. What's the story with all this?
So my strategy behind the ETFs is it's a way to invest in indexes. And by doing that, you're going to be diversifying across a whole heap of different asset classes, different companies. And it's a safer bet, and the fees are lower as well. Now, depending on your investment strategies, that might be the right option, it might not be. But for me, I know that trying to become a millionaire within the next sort of 5 years from investing and doing day trading, is the chances of that happening are a lot lower than the chances of me becoming a millionaire in the next 20 years. Now, it's possible that you can become a millionaire in the next 5 years, without a doubt. People have done it. People have done it before. But I'd rather take the safer route, keep doing my thing, keep living life, invest in these long-term investments, and guarantee myself financial security and independence in the future.
Now, tell us a bit more about your background, though, because I understand you like, in terms of Anthony Robbins, inspired you quite a lot and everything there, and you've been interested in this for probably about the last couple of years, and then you took the dive this year in March of all times. Mate, didn't you realise that there was a pandemic going on at that time? And then you decided, okay, yeah, I'm going to take the plunge right now. What was going on inside your mind at that stage, mate?
Well, I guess the way I see it is, and it could be naive, it could be, whatever, but I think investing is a safe bet in index funds, whatever it may be, as long as it's diversified and your aim is long term, regardless of the situation, the global situation, unless the economy absolutely craps itself and just goes completely downhill and we descend into absolute chaos, and ends up like, what's the book, Lord of the Flies or whatever it is, and we're living on an island fighting for survival.
That's the one.
That's the chances of that happening are extremely low, and if it does, your money's not going to matter anyway. So may as well invest it. And one of the things that I picked up through Tony Robbins' book, Unshakable, which is just Unshakable. It's a broken down. It's a more succinct version of Money Master the Game, I believe. But he says, and all these brilliant investors, like I think Ben Graham's one of them, Warren Buffett, they say time in the market is a much better option than trying to time the market. So I figured I had the cash there to invest. It was a $5,000 minimum to open this mutual fund with Vanguard's my preferred choice. 5,000 minimum. I figured now's a better time than ever. Had a crack. At the time, I saw that there was little things on the news about COVID, and I was like, "She'll be right." Jumped in, and the
virus.
It's funny though. At the time, you just see it on the news. You go, it's another virus or something happening. It's like same as anything. You don't really get how much of an impact it can potentially have, because let's be honest, this virus has impacted the world. Basically, I don't know how to describe it. It's the biggest impact that any one thing has had in a very long time, I think. So you see it and you go, I'll just have a crack. This isn't going to affect it. But I invested 10 grand, and I think within the first 2 weeks of having those investments, it dropped 3 grand or something ridiculous. But my thoughts behind that was, I'm long term, all I've got to do is just hold it and it'll bounce back. And sure enough, it's bounced back, which is good.
What were your emotions doing at that time though? Because that must have been nerve-wracking as heck at that particular stage.
I think because I'd been investing in ETFs for a while, tracking the S&P 500 index, I was used to watching it go up and down. So I didn't quite mind. I already had a decent amount of money invested in these ETFs. So I knew I was in it for the long game. My outlook has always been long-term, next 20, 30 years. So worrying about sort of 3 months, which is really there was a big down period of about 3 months. That doesn't really make much sense. And it bounced back. And what I did was I kept investing while it was down, because all of the content that I've read from all of the greats, dollar cost averaging is the way to go. Time in the market, if you just keep dollar cost averaging, which is you invest consistently, same amount for a period of time. So I invested in March, the market was up here, it shit itself. Sorry for the swearing. Market shit itself. Dropped down to here, and then starting to creep back up. Throughout all of this, I'm investing here, all the way along, so I get the average return.
Obviously, it would have been at a lower price as you're going through each month.
Yeah, exactly. And like I said before, unless civilization collapses, the economy is always going to go up. It's always going to trend upwards over the long term.
Yeah.
So I didn't stress too much. If I had needed that money, that's the only time I would have lost anything. So if all of a sudden the market dropped and then I realized I needed money for emergency surgery or something just out of the blue, that's going to be a problem and it'd stress me out. But the thing that I've got is I've got a buffer. So I've got an emergency fund that I don't touch of 3 to 6 months worth of expenses.
Yeah.
So if something does happen, I know that that cash is there. I can use it. I don't have to pull my investments out at all. Don't have to touch them.
Yeah.
So I've got that security. I'm not going to lose. I think I'd even rather get a loan out than actually pull my investments out anyway.
Using other
I didn't know what the interest rate on the loan is first, but
yeah, because that's one of the important aspects to take into consideration as well. You've got to have additional funds if you're going to use a dollar cost averaging perspective to be able to actually purchase more during those downturns.
Yeah, ideally I would be purchasing more during those down periods, but because it was an initial minimum of $5,000 for these 2 funds that I opened, it was 10 grand. So that was a big chunk of my liquidity that I used to open those accounts. Mm-hmm. So I didn't have a heap left to invest. And like I said, that my buffer, I wasn't going to touch. So I've got that buffer sitting there still. Mm-hmm. I'm not going to invest that because that's my security. That's how I stay level-headed. If that's not there, that's when I start to go, oh shit, what's the market doing? So, okay. Can't remember where I was going.
Sorry about that. What I was about to ask more than anything was, did you find that at least helped out a little bit from the emotional perspective as well? Because it's, everyone always says, you're going to try and cut the emotions as much as you possibly can, but you can never 100% eliminate emotion. It's more of a matter of trying to minimize it as much as you possibly can, but you can never eliminate emotion, not even as a short-term trader like myself. How did you find that went in terms of having that buffer behind you to at least calm the emotions down a little bit?
Yeah, without a doubt. The buffer definitely calmed the emotions. But I think the thing is, it's normal to experience emotions like everyone does. And you want to stay as level-headed as you possibly can. But it's more so about not letting yourself make rash decisions because of your emotions, because that's when you stuff up. So it's about identifying, all right, the market's down. I'm not feeling too good about that, but what's my game plan here?
Yes.
And you go back and then you look at your game plan. You've got your game plan already set out. You know what it is. It's drilled into your head. So I don't necessarily have my game plan written down, but it's in my head. My strategy is there. So I know, all right, the market's down, but this is my plan. This is what I expected. There's no need to worry about it. There's no need to make any bad decisions here. And it's the same when the market's up. Like when the market's up, like you get excited. You're like, brilliant, market's up. Awesome. Keep following the game plan. Like I don't look at with my dollar cost averaging, I don't do the investing myself, so I don't go in each week and do it. It's automated. So each week, money gets paid from my account into my investing account, and it's just done automatically. So I don't think about it; it just does it for me, and it makes it you just sit and forget.
So nice and automated. No matter what the market's doing, even if it's going up, you're still putting in, you're still dollar cost averaging, even as the market's going up all the way through.
Yeah. Exactly. And that's based off the long-term approach. If you're a short-term investor, that's not the strategy that you'd use unless you wouldn't use that if you're a short-term investor.
Definitely not. It's more selective in terms of actually looking at specific stocks itself there, and stock selection is one of the more important aspects there than anything else. Yeah. And then you're basically, you're setting your entry and your exits, and you're saying, it's hit the stop loss, for instance, which is another aspect I wanted to have a discussion with you about there too, because obviously your stop losses is not really a common kind of thing that you would be having in your strategy, because you're doing a continual aspect of dollar cost averaging, just continually putting in. Stop loss wouldn't really be applying in your circumstance because it's that long-term continual aspect.
Yeah, exactly. Not at all. So the only time I've used a stop loss was when Bitcoin was booming, and It was right before the bubble burst, and I can't remember what app I was using. There was one app that was really, I think it was plus 500. That's not I've got nothing to do with plus 500.
No worries.
I jumped onto that because I saw this whole Bitcoin stuff going on, and I saw that I could trade the CFDs with Bitcoin. So I didn't know Bitcoin, but I could do pretty well watching it trend upwards. So I'd watch the charts, and I figured out a little bit of watching the charts and figuring out what was going on. I'd set some stop losses there. I went all right a few times, but then the bubble burst. I think I lost. I made 1,000 and I lost 1,000, but I learned, and then I was like, yeah, I'm going to put this one down.
Fair enough. And so sometimes you just got to learn one way or another as to what works for you. That's one of the biggest things, especially when it comes to investing in trade. So no, you've obviously found something that works well for you, which is absolutely fantastic. But in terms of the ETFs that you deal with, and speaking of things that work well and what don't work well for you, how do you go about actually selecting specific ETFs? Because there's a huge, enormous range of actual ETFs that are available. So do you have just a select number that you go for, or do you basically just plow into one particular ETF itself that you feel more comfortable with?
So the way I did it was, obviously the book Unshakable by Tony Robbins got me looking at the S&P 500 and looking at that index. So I went through and I had a look at the different S&P 500 indexes that were available in Australia to purchase through CommSec. And I was predominantly looking for good companies, like really reputable investing companies. So I was looking at, the two ones that I was looking at was Vanguard and BlackRock.
Okay.
I had a look at their ETFs. I compared them, figured out which one I liked the most, which one was the most popular, popping up the most in all the forums online. And IVV, which is the BlackRock S&P 500 index, that was my first one that I started investing in. So I went, yep, that's the one, S&P 500 index.
Okay.
I'm going to start funneling as much money as I can into that. Also, I had a look at Australian shares as well. So I wanted to invest a little bit in Australian shares. So Vanguard's VDHG, Vanguard Diversified High Growth. I believe they're more predominantly Australian shares, I believe. I could be wrong there. But I invested in them as well. And the good thing that I found out about them the other day is VDHG have a reinvesting plan. So when you get your dividends paid, you can actually just set it up so that the dividends that you paid get put aside and reinvested into that fund.
Oh, okay.
Now, there are funds that do and don't do this. My IVV, my BlackRock S&P 500 index, they don't actually have that facility, unfortunately.
There's differences between brokers as well.
Pardon?
There's differences between brokers as well that you've actually found too.
Yeah, yeah, exactly.
Oh, so there's another tip for the newbies.
Yeah, so some brokers, while a fund may have a reinvestment plan available, some brokers don't actually do it for you. So you need to find a broker that will actually allow you to utilise the reinvestment plan.
Incredible.
So CommSec is one that allows you to do it, at least with VDHG that I know. And that's important to me because now that I've invested in the mutual funds and my IVV isn't reinvesting, I'm less drawn to that now because I know for me to reach my financial goals, I need the fund to be reinvesting my dividends automatically. So I don't have to do it because that's where the compound interest comes in and your portfolio skyrockets.
Yeah. Well,
and that's really important for me.
Yeah, and you're a young guy as well too, so you've got plenty of time in front of you, so you can go boom, straight off there and just let the compound interest do its own thing as well too. So absolutely in itself. Speaking of which too, I wonder whether you've also thought, because we'll also talk about broker differences and things like that as well, but has there also been a thought in terms of doing something like this in terms of investing in your superannuation as a possibility too? Has there been, is there possibilities behind doing that? Because you can actually purchase shares as well as ETFs and licensed investment companies using do-it-yourself options within superannuation. There are a large number of superannuation companies doing that now, and that would possibly also be allowing dividend reinvestment through that too.
Yeah, okay.
So whether that's a possibility there, you can do that in combination with what you're doing as a strategy there. I don't know, it's a possibility of investigating that. Even for anyone else who's even watching on too, thinking about that as a possibility there too, worthwhile investigating. Obviously not advice, but something to at least think about and look into as well. What do you think of that as a possibility? I'd love to get your insights on that.
Well, I haven't looked into it too much. I'm not very familiar with all the superannuation stuff. For me, the thing is that I found out as well is different superannuation companies have different types of investment strategies as well.
Yep.
And I think it was Rest potentially. They've got options. So you've got conservative, balanced, and aggressive,
Yep.
that sort of thing. So you can actually go in and select what type of investing you want done in your superannuation.
Yeah.
So you've got a bit of control there. So when I realised that, I went into my super and set it to aggressive because obviously I'm 25.
Yeah.
I don't plan to take super out anytime soon.
Neither should you. I think you'll be able to do much with it anyway.
Exactly. So yeah, selecting that aggressive option. Sorry. Selecting that aggressive option, I think, is something to consider if you're a young investor. It depends on your goals.
Yeah, definitely. But I know definitely a lot of superannuation companies are now offering a do-it-yourself kind of option where they do allow you to, I think it's anything up to about 80% of your portfolio, but you can actually invest in the top 300 ASX companies, as well as ETFs and licensed invested companies that you can select. So you actually do place the trades like you do with a normal stockbroker. Basically,
that's pretty cool.
Yeah, I actually do it myself personally through my own superannuation fund. So it's actually
right
that way. But obviously, it depends on your own personal strategies as to what you want to do. But it's a good way of you being able to actually be very selective personally with what you want to do with your own superannuation funds, your own money in itself, rather than just saying to your superannuation fund, here you go, here's all my funds, go ahead and manage it for me.
Yeah, exactly.
It depends on your own.
The thing that scares me a little bit about superannuation is making sure that the management fees aren't too high, because the management fees is where it'll lead to, if you've got low management fees, it'll give you an extra sort of 5 to 10 years of cash flow when you retire. If you've got crappy super high management fees, that's going to eat into your portfolio a fair bit. And that's something to look at when you're investing in mutual funds and ETFs as well, making sure that the management fees are as low as they possibly can be.
Absolutely.
Because that's going to make a massive difference over the long term. If you look at it from a short-term perspective, it's like, no, it doesn't really matter. But over the long term, they can add up to hundreds of thousands in difference. When you factor in compounding, it's crazy.
Yeah. And do the fees that you actually get charged through your particular ETFs and your investments there that you have right now, are you finding that they're excessive, what you deal with there, or are they manageable overall?
No, I think all of the funds that I'm invested in currently in mutual funds, ETFs, they're all quite low. I know that Vanguard have recently changed their investor platform. So in the past, for someone like me, I couldn't access their wholesale funds, which is a $500,000 minimum to invest in.
Okay.
The thing with those is the management fee was a lot lower. I think it was like 0.03% or something. Don't quote me on that.
Okay.
As a standard for some of their funds. I was having to invest in their retail funds,
Right.
which is a minimum. And I think the fees were 0.9% or 0.09, something like that. 0.09 maybe. But the wholesale funds are lower management fee, and Vanguard have recently changed their platforms. They've now got this thing called the personal investor platform. They don't do the retail funds anymore, and anyone can now invest in the wholesale funds with a minimum of $5,000.
I thought you just got a special Nick Cook rate or something like that. Huh?
What's that?
I thought you just got a special Nick Cook rate or something.
No, not quite. Not quite. Actually, some platforms are there in the process now of switching all that over, which is very handy because you get access to more funds and you get access to different shares as well. So I'm looking forward to.
Okay, right. But you're still going to think. You're still thinking of sticking to your standard S&P 500 funds and.
Yeah, definitely, I'll still stick with international shares. Is one of the ones I'm predominantly invested in with Vanguard.
Okay.
The S&P 500 one was my start off, but the international shares invest heavily in the S&P 500 anyway. So that's one that I'm looking at. Property, bonds, those sorts of things.
Would there be anything that would sway you away from your particular investment strategy? So, for instance, there might be escalating tensions between the US and China, for instance. We've obviously got the US elections coming on this week. Would anything all of a sudden say, "Ooh, okay, maybe I should be changing my strategy overall in terms of what I'm actually doing right now? Maybe I should lighten up on my US S&P holdings and then changing across to Europe, for instance, or going across to emerging markets, or switching across to the Australian market, for instance. If you felt as though there's a bit more of a recovery and a bit more strength here. Not that I'm trying to pervert you in terms of any of your thoughts, because I've got no idea what's going on around the corner itself. But would anything sway your thoughts in anything in the future, perhaps, or make you change your objectives for the future?
It'll have to be significant, but it wouldn't be necessarily like I wouldn't pull money out of a fund because of some sort of crisis. If there was a world war or anything, honestly, I'd just leave it in there. Because even over the course of world wars, the market's still trending upwards over the long term. I just got to make sure that I survive the war.
But we all.
The one thing that I've considered right now that's not necessarily changing my investment strategy, but more leaning me towards a certain asset class is the fact that the Australian property market is down massively at the moment. So the REITs, which are the real estate investment trusts, the property mutual funds that I'm invested in, they took a massive hit. So they're down, like discounted heavily. So when something's discounted heavily, that's when I sort of start going, maybe it's a good opportunity to invest a bit more heavily in this. So lean my cash flow, like from my investments, towards the property as opposed to the international shares. So that's what I'm thinking about at the moment.
Right.
Yeah, that's predominantly what I'm looking at.
That's interesting. I think there's been a lot of bond buying going on as well recently too. There's a bit of a spike going on there as well. And I think even in the, if memory serves me right too, even from the recent the watch list that I had maybe last week, there was a fair bit going on in the, I think maybe even been the Vanguard bonds ETF. There's some activity going on there too. So it's interesting things going on. Now, I think it's very interesting how they even coincided with, obviously, we've got the RBA meeting going on tomorrow with the Melbourne Cup holiday.
Yeah.
There's been a recent announcement there going on too. There may actually be further lowering of the interest rates too. They're trying to spark up the economy, obviously. So,
Yeah, right.
yeah, exactly. It just seems like there's this perfect storm of everything going on. It's just quite crazy. It's yeah. So maybe your thoughts are right in terms of put a bit extra into that and keep things going on a prolonged basis and get things moving that way too. So yeah, your thoughts might be going pretty well there too.
And I recently actually opened up a Vanguard mutual fund in the bond asset class as well.
Okay.
And the main reason for that is, one, I'm saving for a holiday to Europe in the future, and two, saving for a car. So about a month ago, I realised I'm putting all this money aside in the bank, saving it for these things, and it's not really doing too much for me. So I went and I calculated, had a look at all the different bond funds that Vanguard have, and had a look at the performance over the period, what it looked like, compared, I think, 4 of them, and I landed on one and went, yeah, that's the one, may as well put my money in here, because it's 100% treasury bonds, which mean they're all government backed. So it's an international bond fund. So 100% treasury, so all government backed. So super secure. And I'm getting, let's say, 3 to 5% a year from that. I'll get approximately that. I can expect that. So if you can put that money into this bond fund, and at least while it's sitting there, it's doing something. But it's still safe. It's a much safer investment than the international shares or property, that sort of thing.
Okay. I love the word you're using in terms of safe.
What's that?
I'll be honest with you. I love the word you're using in terms of safe, because
Safe.
Safe. The word safe. It always concerns me when a person uses the word safe. It always brings up the antennas on my head in terms of the word safe, because I can bring up a chart basically about a whole heap of different ETFs even themselves, and you can see it goes straight down, and it's just like safe. It's just a skeptic in you. Don't worry. But yeah, but it's true in terms of like safe in itself. I suppose it's a relative term that what some people will consider to be safe and what others won't. I suppose it's one way of thinking about things there. But even those things that are considered safe by some people may not really be considered safe by others. But I suppose by what you're doing in terms of your dollar cost averaging, you're bringing it down, and you're going for long-term aspects overall. So for you, that's definitely considered to be safe. But I suppose it also considered in terms of your time frame as well. Someone who's really approaching their retirement may not be considering some of those aspects to be very safe at all, as well as the other side of the coin there too. So I think it really does come down to people's own personal circumstances as to what really can be safe in itself there as well. They really need to take that into consideration too.
Without a doubt.
Yeah.
And I definitely think it's, like you said, it's that time frame that you're looking at investing for. So if you're looking to invest over a 1 to 3 year time period, investing in international shares is probably not the safest option.
No.
Whereas over a 1 to 3 year time period, investing in bonds is going to be a much more, that's going to line up with your goals if you're looking at that 1 to 3 year period a lot better than the international shares.
Absolutely.
Which is my perspective, because with those, with that bond fund, that's something that I'm looking at over the next 1 to 3 years. Whereas with my other shares, my other investments, that's 20 years. So international shares over 20 years, you're going to be pretty good. Like, that's my perspective anyway. And I'm comfortable with losing it if I do lose it.
Well, yeah, exactly right. You've already made that buffer for yourself there too. So you already, and I think that's best advice you can probably give anyone, I suppose, anyway, too, if you're giving advice. But at least it's a good tip to provide that you never invest with anything that you can't afford to lose. There's no doubt
Yeah,
about that whatsoever. Never invest or trade with anything you can't afford to lose. But
yeah,
yeah, but I suppose speaking of which as well too, I suppose before we end up the conversation in itself, when you think about it too, well, what final pieces of wisdom or advice, or would you even want to offer a newcomer to the market when you think about it? Especially, you look at yourself. You've come into this market in March, really, when you really delved into it 100%. You said, right, I'm going to plow into this. I'm going to go into this at a time when you say, whoa, this the world's in chaos, but I'm going to give it a go anyway. I've got nothing else really to lose. I've got a nice buffer behind me, but I'm going to give it a try anyway because I've got confidence in myself. I've been following this all since about 2018. I think you told me in another conversation before. You've been tracking all of this. You're feeling really confident about your strategy, but I'm going to give this a go. It seems like the world is going a little bit crazy, but what little nuggets of information you've given us so much already today. So I'm really thank you for that. It's been absolutely great chatting with you. But what
yeah.
little nuggets of info would you give to a newcomer who's considering something like ETFs or long-term investing? What little bits of advice would you be able to say to someone who's coming into the market new, and what they're unsure of what direction they'd like to do? Would I be able to go long-term? Would I be able to use an ETF? Or should I be going for short-term and just using stop losses, doing day trades or anything like that? What would persuade them to go towards an ETF or something long-term instead? What do you reckon?
I think having a multifaceted plan is a good option. Like even for me now, I'm starting to do a little bit more day trading. So ZipPay was one that I invested in right before it just shot up. And that was it was a gamble. So it was a gamble that I was willing to lose, but I knew that there was some decent upside potential of doing that. And I was doing that while I was continuing my investment strategy in the long-term side of things. So I'll always have that underlying base of my long-term investing strategy. And then on top of that, if I want to do a little bit of trading as opposed to investing and a little bit more of a gamble, I'll still do that. If I see a company that's in a good position and I like the look of it, I'll have a crack at it. So with Zip, I was working retail and I had one of my retail managers tell me about Zip, and Zip was just getting signed on as a payment thing for SRG, which is Super Retail Group, which is a big company in Australia, Rebel, BDF, that sort of thing. Mm-hmm. And I saw that. I had a look at Zip. They've just signed on with SRG. They've signed on with a whole heap of other places. I'm seeing their little logo everywhere, and it's $1 a share. It's $1 a share. May as well throw a bit of money at it. Mm-hmm. And I got out when it was at $7.
Oh, congrats! Nice work.
Yeah, and I got what I wanted out of that investment. I set my target and got what I wanted out of it. And this was before I joined any online forums, so I wasn't seeing all these posts coming up of Zip. People getting shitty at buy now, pay later. I wasn't seeing any of that. I was literally just watching the price go up and down, and I was going, it's pretty good as long as I just hold it. Like it'll drop down something crazy, and then it'll go back up and drop down, go back up. Yeah. And then one day I saw it hit 720, I think it was, and I went, that's a good one. That's pretty close to my target of about $10. Yeah. I think this is the time. This is the time. Well, I guess little nuggets. That's not really a little nugget.
No, actually, I think it was, because really, when you think about it, you saw the value in the company. That was you saw the value in the company back then with Zip. You saw its relationship with the Super Retail Group, and you basically said, look, I would not mind owning that company. You'd be happy to be a shareholder in that company. And you were. There's no doubt about that at all. It's the same as what you're doing with the ETFs. You're happy basically saying, I'm happy being a part owner in the S&P 500, which is a composite bucket, when you think about it, of all top 500 stocks over in the US. You are happy being a part owner of those 500 companies. That's a good way of thinking. You know, it's the same in terms of owning the bonds of the ETFs and everything there as well. You're a part owner of all of those. You are proud to be a part owner of that.
Yeah.
Isn't that the basis of investing when you think about it?
Yeah, exactly.
If we all thought that way, it would be a better place.
Yeah.
It's as simple as that. You know, and instead of everyone thinking of these rocket here, rocket there, all that kind of stuff there, and then just not having a clue about what they're really doing, because unfortunately there are so many new investors out there. It's exactly how they're thinking, and they have no idea. They're not educated up here in terms of knowing what the share market's all about. It's actually ownership of businesses here we're talking about. Yeah. But no, you've an absolute for new investors without even realizing it. You definitely have. What else were you thinking of as you were going on there, though?
So, I guess succinctly, if I was going to lay out a plan for me 2, 3, 4, 5 years ago as to what to do to get into investing, it would be 1, go and read or listen to Unshakable by Tony Robbins, just because it's going to explain the long-term investing strategy. And then from that, you can go and look at different other information sources, that sort of thing. Benjamin Graham, Warren Buffett, have a look at those guys. Do your own research on long-term investing, dollar cost averaging, but start with that book, Unshakable. Once you've done that, go and open up a CommSec account. All right, in Australia, it's easy. I don't know any other. This is just how I did it. And this is my advice to myself 5 years ago. So read the book, go and open up a CommSec account, and do your research on whatever ETFs, long-term investing thing that you want to invest in. Once you've done that, invest. It doesn't matter how much. You can start, I think CommSec, it's $500 minimum. Just put that in just so that you've done it, so that you're not scared of it. Really so I think one of the big people are scared. They don't know what's going to happen. They don't understand what the ETF is, what it does, what could happen. But once you're in and you watch it go up and down a little bit, and you go, all right, this is what it's doing. Your foot's in the door. You've gotten used to it, and from that, you're going to be more. You're literally invested in it. So you're going to be invested in it. So you're going to start learning more and picking up bits of information. So once you've done that, then it just flows. So read the book, open up the CommSec account, research whatever funds you want to invest in, and then just keep learning. Make your first trade, make your first investment, and then just keep learning after that, picking up from there. And obviously, look into mutual funds, anything that's got low management fees and a decent return, and it's easy to diversify. You can diversify it. There's options there for you. Do that. Yep. They're the nuggets that I'll be going for.
That is really good, actually. I love all of that. And I think your point, especially about actually placing a trade and really getting the skin in the game, really, because that's what it basically is. There are so many people that I've met along the way. Like now you're 20, you're 25. I'm actually 44. And basically I've been my first trade when I placed mine, I think was when I was about 17, and it's just like, oh man, it's a long story. We'll go into another time. But since then, it's been a long journey all the way through. But the number of people I've met along that journey, and there's so many people who have still not placed a trade, and it's frustrating because of fear.
Yeah,
all it is. It's because of fear. But once you've gotten past that, and you've actually said to yourself, "Hey, it's not that bad. It's okay. I didn't die. It doesn't kill you." That's the thing. It's the same no matter what type of instrument you're trading, be it shares, be it options, be it futures, be it whatever, foreign exchange, no, it doesn't matter. The mere fact of just placing the trade on, it's okay. You will survive. Okay, that's the thing. As long as you know how much you put at risk and you've dealt with it, that's fine. That's the key.
Yeah.
So yeah, placing the trade is one of the most important things. But once you've actually got in the game, it really makes a big difference. There's no doubt about that at all.
Yeah.
Awesome. Yeah,
Exactly.
really, really good.
And it doesn't have to be.
Doesn't have to be big.
Doesn't have to be a heap of skin either.
No, exactly. And the same as even CFDs is a good way of introducing yourself as well there too. You can place trades really, really small.
Yeah.
Really small.
Yeah.
Not involved massively at all. But unfortunately, so many people don't educate themselves and know enough about it. They place massive trades on with so much risk, and they go, "Oh my gosh, what's happened?" It's like, "What'd you do?" It's like, "Oh man," it's just crazy. But you know, it's just a matter of just knowing what you're doing half the time as well, and it's just absolutely bizarre. Yeah, but no, really, really good nuggets of information there, mate. Really, really incredible. It has been awesome speaking to you. Before you go, I have one more question for you, my friend. Now, what would this be for you? If there was one thing you could change about the markets or the world in general, what would that be?
Ooh.
It's a doozy, isn't it?
That is. My first thought is financial education in schools would probably, that's what my mind went to first.
Oh, you are my next best friend, mate. That's all I can say. That is so true. It's so true. I think it's starting, but it's slow.
Yeah. Yes, it is slow.
Yeah, it's really slow.
If I had have had someone or a class where I sit down and someone taught me this stuff, like your financial independence, financial security, your future is so secure once you've got this knowledge. And it's something that I want to just explain to anyone watching is obviously I invested right before the market crashed. I've been investing since 2018 in the ETFs. I think my total gain, I believe, was 10K or so right before the crash. When the crash happened, I lost 3K or so from the mutual funds that I just opened, and my CommSec account dropped to, I think, minus 3,000 from plus 10,000 or so. So I dropped down from a 10,000 gain to minus 3,000. Now, if I had shipped and sold all that, I would have locked in that loss. But I didn't. I held out. I dollar cost averaged, kept buying in. My CommSec account is now back up to 5K in the green, and my mutual fund investments are, I think they're only a few $100s off being what my total cash invested up until this point is.
Okay.
So I haven't lost anything. Because I dollar cost averaged, I stayed in the market, I stuck to my plan, I'm not out of pocket. I think that's something that's really important with this strategy for anyone going forward with it.
Yeah. You're obviously really satisfied with the results, and you've got the results to prove it as well, which is great.
Yeah, exactly.
Nice and done. All right. Well, that has been mind-blowing. I've absolutely really enjoyed this conversation, mate. So thank you so much for your time. Your insights have been really invaluable. Is there anything else you'd like to share whilst we're here before we knock off this?
No, mate, it was my pleasure. I appreciate it.
Absolutely terrific. All right. Well, thank you very much for your time. I really, really do appreciate it. And if there's anyone who actually wants to ask Nick any further questions about this, I'm sure he'd be more than willing to be able to share more insights with you as well. So feel free to get in contact with Nick either through the forum. I think he's also given you his email address or address details before as well too. So feel free to contact him through there as well. And look, by all means, we've still got the forum obviously available too. So feel free to link in, get in contact with us through there as well. So we will see you on the forum soon. Bye for now.